Good morning, everybody. Welcome to today's 1Mby1M Strategy Roundtable for Entrepreneurs. 1Mby1M, as you know, is the first and only global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million in revenue and beyond, build $1 trillion in global GDP and 10 million jobs. And in support of that mission, we do these free public roundtables week after week after week. This is the 453rd episode. It's been going on since the fall of 2008. The event is being recorded. All recordings are available on our YouTube channel, 1M1M Roundtable. If you are following us on Twitter and would like to live tweet today, please use hashtag 1M1M. Our Twitter handles are at 1M1M and at Stromana. We publish a lot of interesting content through those channels. And these are the call-in instructions. After our scheduled programming, we're going to go to Q&A. So by all means, participate as much as you would like to. We're going to start today's conversation with Jonathan Nelson, CEO and founder of Hackers and Founders and Managing Director of Hack Fund 5. Jonathan, welcome to the show.
Thank you very much for having me.
So I guess we should first get acquainted. What are you doing? What's your background? And what are these two organizations, Hackers and Founders and Hack Fund?
Absolutely. So Hack Fund 5 is our fifth fund, and we are taking it to IPO in London, end of this year, beginning of next year, with the purpose of connecting the rest of the world to Silicon Valley. Why we are taking a venture fund to IPO comes from the first organization, Hackers and Founders, which is really, it started off with me and a handful of nerds in a bar talking about startups about 11 years ago. Now Hackers and Founders events have been held in about 152 cities around the globe, and about 300,000 tech entrepreneurs have attended Hackers and Founders events. And it has been the challenges of companies around the world and entrepreneurs around the world that have actually led us to want to take a venture fund to IPO. The superpower of a publicly listed venture capital fund is that we never have to ask an entrepreneur, what's your exit strategy? Why? Because our investors don't have to wait for our portfolio companies to get acquired for our investors to make money at Hack Fund. Our investors make money when they buy, sell, and trade our stock. So our job at Hack Fund is to grow the value of our companies by growing their revenue. So that gives us a superpower. We can invest anywhere in the world as long as that company can grow and grow and invest aggressively in value. And that's one of the reasons why we're actually taking this fund to IPO. That stems from a couple of years that I spent at the SEC.
What is the business model? So right now, you're not public. So who are the limited partners of this fund? What is the size of the fund? What are the vital statistics of the fund, as we say, in the business?
Yep. So our first four vehicles, we've worked with about 120 investors. Our business in the previous four funds has been, it's a bit weird, has been services for equity. We were helping companies land in Silicon Valley and then scale globally. They would pay us in stock. We would bundle that stock and sell off half of the bundle.
It's a services business.
Our first four funds were us bundling stock from the startups that paid us and then selling part of that off to pay our bills. We worked with about 60 companies. They raised about $125 million in outside capital. And we've had 9 acquisitions from those first four vehicles.
And so you have a vehicle that takes equity in these startups in exchange of services, and then you sell that equity to this group of investors.
We sell part of the bundle to those investors, and that was our business model for the last 6 years. With the fifth fund, is we will still do equity for services. We will also be able to invest capital ourselves instead of working with outside investors. And we will be able to, the target for Hack Fund, our fifth fund, is a $200 million IPO. end of this year, beginning of next year.
Is there any precedence of this kind of an IPO in the market?
There is one fund in the United States called GSC Ventures. They primarily focus on very large investment, Series B plus investments. There are a couple of dozen of venture funds like this in the UK, probably the most popular of them being Draper Esprit, and they have about $1 billion of assets under management. We are going to be one of the first from Silicon Valley doing the IPO in London, but really focusing on global entrepreneurship.
And how does the public market evaluate these companies? Because, you know, as you know very well, private companies don't disclose much.
Yep.
So what disclosures are you going to provide to the public market for people to be able to even analyze this particular vehicle, your Hack Fund 5?
Yep. So we have a third party. When we invest in the company, we'll act just like any other venture funds to our portfolio companies. They do need to agree that their valuation will be public. We have a third-party company called Carta, which will provide a valuation of each of our company portfolios. It's a rules-based valuation engine. That gets audited and that gets reported publicly. And so our job is to increase the value of that valuation, of the value of those companies based on those rules over, you know, quarter to quarter, year to year. And one of the biggest mechanisms that we can actually use to do that is to help our portfolio companies grow revenue. So it's a bit of a different model. We're an invest to grow model as opposed to kind of a traditional venture capital, which you can kind of think of as an invest to flip. You have to invest in companies that get acquired by Google, hopefully for $1 billion or more, for everybody to make money in the stack. Our model is going to be different in that we invest companies to grow them, and then have a third party value that growth, and then that gets reported.
There are a number of issues with what you're saying, and I'm trying to understand the model. You know, that's what we do. So,
of course,
I guess the first thing that comes to my mind, you're insisting on not built to flip, but built to grow. At the same time, your assumption, it sounds like, is that these companies that are in your portfolio are going to be raising venture capital elsewhere. Is that a correct assumption?
We will be investing in the companies ourselves. If they wish to raise money from other venture capitalists, other angel investors as well, more than happy to do that, whatever's in the best interest of the company.
So the venture capital model requires exits. Even if you don't want exits or you're not focused on exits, by definition, if your companies in your portfolio raise money from the venture capital industry, they have to exit. So in a way, the claim that you're making that you don't invest in companies to flip, you invest in companies to grow, it's kind of like a non sequitur claim, because it doesn't matter. As long as there are other VCs in those deals, they are going to need exits. So can you comment on that?
Yeah, we can also do secondaries. So we can also buy back the stock from other investors if that is what the startup wants. And we often lead the deals. Sometimes we're the only investor in the deals. If I like to give our portfolio CEOs and our founders options, another option that I think is on the table is to actually IPO a company sooner rather than later on the London AIM exchange. I spent 2 years on an SEC committee looking at capital formation and looking at the challenges of investing outside of Silicon Valley and finding out why so much capital got invested in Silicon Valley. And the problem is that 85% of the world's acquisitions in the world of technology happen in and around Silicon Valley. And so that's why 2/3 of the world's venture capital gets invested in and around Silicon Valley. And so it's really hard if you're an entrepreneur in Buenos Aires, if you're an entrepreneur in Eastern Europe, if you're an entrepreneur in Asia Pacific, to raise capital from investors unless you can promise them that exit. We took a long, hard look at that, and we said we need to build our own liquidity with us and carry our own liquidity with us as we actually invest around the world. And what is the best way to do that? I believe the best way to do that is publicly traded venture capital funds, and then also offer and help the companies actually achieve liquidity sooner. If you can do $5 to $10 million a year in revenue, you can actually go public on the London AIM exchange. That's actually a decent IPO for them if you're growing 30% year over year. And so earlier liquidity to actually help these companies go public earlier, I think is a good option. Investing through a publicly traded venture capital fund is a good option. Being able to buy out other investors who are getting crabby because there isn't an exit, I think can be a good option. But my goal is how do we help, 1 million entrepreneurs around the globe get $1 million a year in revenue without being able to raise venture capital, without being able to, how do we do that unless we can actually solve some of these liquidity challenges? And that's been kind of our focus, is trying to bring solutions so that more entrepreneurs around the globe can actually be more successful. I think one of the inhibitors to more investment globally is this lack of liquidity, and that is why we're doing what it is that we're doing.
So let's talk about some examples. You said from your first 4 funds, you've already had a bunch of IPOs in the London Exchange and so forth. So let's just walk us through a few case studies of what kinds of companies, when did you see them, where are they from, what kind of exit did they get, and what was the journey of a company? Maybe do a couple of case studies.
Yeah, so we've had 9 acquisitions from our existing portfolio. Our first 2 IPOs on the London AIM exchange will be, God willing, beginning of next year. So companies that we've worked with in the past, one was called Finata. They were a Silicon Valley company. They were building distributed cloud search over your business documents. So if you use Box, if you use Dropbox, Google Drive, they provided a unified interface to actually be able to search over all of your documents in your company through this kind of federated cloud search. They got acquired by Cisco, and it was a talent acquisition. The team essentially ended up becoming running Cisco's cloud search for a number of years. The entrepreneur has since spun out and is actually working on the next company.
So hang on. Let me understand this deal. How much money did this company raise all total before getting acquired by Cisco?
I believe they raised about $1.5 million.
So it's a very capital efficient company, mostly angel investors or micro VCs in the deal.
Yep.
And your contribution was you provided some services and got equity in exchange.
So that was equity in exchange for services. We were one of the first people that got involved. We had kind of an accelerator-ish program, and then we actually continue to support them over the next 2 or 3 years as they needed and as they actually grew, help them with hiring, help them with business development, help them with scaling and that sort of stuff.
Okay. So are all the 9 acquisitions, all of them follow the same kind of model? It's like small capital efficient deals that got acquired at small valuations?
Yes, we did have one 8 or 9 figure acquisition, which is under NDA in terms of the specifics, but that was, But most of them were small, relatively capital efficient companies that actually had relatively smallish acquisitions.
And is that where the sweet spot of your next phase of work going to be? You're going to try to, this capital that you're trying to raise, that you want to put into the companies, are you going to focus on these small capital efficient entrepreneurial paths? Because that gives, that is a somewhat underserved category, because as you know, the VCs tend to want to invest a lot of money and, you know, and go swing for the fences. Basically, a lot of VCs are looking for unicorns, whereas these smaller capital efficient deals tend to not get as much attention, and I think we have relationships with investors now, small micro VCs who are looking at that as a category to invest in and seek early exits and all of that. Is that the sweet spot of your?
So the sweet spot for our fund will be companies that have a product, are making revenue, and that we feel like we can add value in helping those companies scale globally. Our check sizes will be anywhere between $100K on the low end to $12.5 million on the top end. And we actually want to have a very broadly diversified portfolio. We are agnostic as to does the company want to exit for, you know, a couple $1 million? Does the company want to exit for, you know, $100 billion, or does the company want to grow revenues? We really focus on what the entrepreneur wants. How I'm graded is the value of my portfolio as valued by a third party on a quarterly basis, and I need to grow the value of those companies. So I can, in terms of my fund, be agnostic in terms of the types of acquisitions. And if the entrepreneur wants a small-ish acquisition and have a life-changing event so they can become a millionaire, that's a great opportunity for us as well, because we participate in that liquidity. If the entrepreneur wants to grow that company, we can do that. We can really, because of the structure of our funds, be agnostic as to the type of exit that the company actually wants.
So there is one, your point is well taken, the size of exits can be whatever, but if there is no exit, then how do the investors make money?
So our investors sell their stock. If they want to cash out, they can sell their stock. Our share price fluctuates. And so you buy stock low in a public market and you sell stock high. My job as a fund manager is to grow the value of that stock. And so we need to grow the value of the companies in our portfolio. And we report that.
You would just put a valuation, you kind of get a valuation done on these companies that do not have exits, and report that as the valuation as part of the fund's valuation. Interesting model. Okay.
And then if there's an exit, that money gets reinvested. That money does not flow through to our investors. It's an evergreen vehicle, so that money actually gets reinvested into the next generation of startups.
Okay, got it. Interesting experiment. Good luck with that.
Thank you.
Thank you for coming today, Jonathan.
Thank you so much. It was a pleasure being part of this.
So, folks, we're going to switch to the entrepreneur pitch section, and let me just set some expectations here. This is a safe working session. You don't need to be nervous or defensive about anything. Our only agenda is to work on whatever issue that you are stuck on or are struggling with, or need to strategize on. Remember one thing: not all businesses can raise money. Not all businesses should raise money, and raising money doesn't guarantee success. There are a lot of good businesses that may not be good investments. So just because investors don't want to invest your business doesn't mean that you cannot build a good business. In our book, $1 million, $5 million, $10 million, $20 million business that may not be very attractive to investors is still a good business, and you can have a very, very successful life building these businesses. So that's just the philosophical underpinning of 1 million by 1 million. And that's something that you're going to hear over and over again. On feedback, if you disagree with feedback you get here, that's fine. It's your business. So you're going to decide what strategy you're going to follow. You can just take the feedback, think about it, and then decide whether you want to apply it somehow or not. We're going to talk with Subodh Pathak first. Subodh is actually a premium member of the program, and he is a winner of the Oracle 1 Million by 1 Million Intrapreneurship Scholarship. So we have worked with Subodh several times before, and this is a catch-up session. So Subodh, for the benefit of the whole room, you do need to provide a bit of an overview of what you're doing, notwithstanding the fact that I already know what you're doing, and so that everybody can follow along, and then go ahead and go to your questions.
Hi, Sharmana. Hi, everybody. Sharman, shall I go through the idea first and
yes,
then come to the point that I want to discuss with you?
Please do that.
Maureen, then we can start with the first slide only. Next slide. So guys, I'm Subodh Pathak. I'm a banker by profession, working for a banking software. And last 23 years, I am in banking domain. So this is giving me some idea that we can implement, or a problem statement that I come with is on the next slide. So, Maureen, next slide, please. So banking is a business where compliance is very much important. It is like a central bank of a country, or other regulators like the government, or even the bank has its own process. And everybody expects that the end user who is using the core banking software should follow all the processes. Now the challenge is the people and the lapses. So many times people forget to follow a process. If there are 10 tasks involved with a certain sequence, people forget the sequence. And there is a lot of iterations of the things, or the supervision is an additional overhead. So these are some of the challenges that bankers find, that how to make people follow the process is a basic challenge in front of bankers today. And everybody expects that since manual work is replaced by a banking system or a core banking system, well, the core banking system should take care of the people's work. So that is a challenge. And also bankers expect that supervision should be minimum, training cost should be less. So as in all industries, these are the focus points. And this was the idea, or rather the idea behind the chaperone. Now chaperone is a person, it's a French word I think, and it means a person who accompanies and look after the group of kids so that they behave properly. So, my idea is something of this type only. Now, it is, when I started with the concept, I was using the workflow module, or I was with the concept of a workflow. So, these are workflow messages the bank can define. Now, ours is a core banking product which is actually used by the bankers while giving or depositing cash and withdrawing money, calculating interest. So all these things are done by my software. And I am planning for a module called Chaperone, which will give the banker or the bank IT team, it will empower the bank team to define a certain process. Well, there are various screens to do tasks, and many tasks are included in a process. So the banker can define a process. He can define what is the sequence, what should be the sequence of these tasks. And what Chaperone will do is it will remember the sequences, and whenever user goes for particular process or he goes to do a particular task, well, this Chaperone module will provide, or it will bring in front one sequence, one screen after the another. So in a given sequence, the user will be prompted to do a task. Okay, first do this, then step 2, then step 3, step 4. So the benefit is basically minimization of user mistakes. Even if I don't know a sequence, then the system is guiding me. So it is like a guide in a new city. It will tell me what to do and when to do it. And it is also definitely saving on cost. You can go to next slide. You can skip this. Go ahead.
You want the next slide after this?
Next slide. Next slide, please. Yeah. So this is not, Chaperone will not compel the user to do a particular thing, but it will tell you, okay, logically you are supposed to do this task now. If the user has already done the task, he can skip that particular screen and go to a next screen. So this is just hand-holding and not compelling the user to do certain things. We can move ahead. Next slide. Next slide. It's a guided tour, that's what I'm saying. Now, how the screen will look like. Now, I have taken a customer onboarding kind of concept where the Chaperone will intimate that, okay, you have added a customer. Now, do you want to capture his documentary details? Now, Documentary is another software where Chaperone will take the user to. So even if I don't know that I have to capture document, this message will tell me that, okay, document capture is the next logical step that I have to do, and it will also take me to that particular software or the screen. Next screen. Yeah. Why Chaperone is? Chaperone is a value addition in our existing product. Because this is something that is required by banks, and this is a valuable addition. Secondly, it is empowering the user to do his customizable workflow. Every bank has its own process. So each bank can define or customize the workflow according to its requirement. Thirdly, every customer is concerned about the cost for additional software. Now, there are various workflow softwares in the market. Okay. So if I tell somebody that, okay, go and acquire a new software, it means there is an additional license cost. Also, it means that I have to find people who have that skill set. And many times the banks do not want to involve more and more people in these peripheral softwares. So Chaperone is doing the basic work that is required by the bank without any additional skill set involved. So that's why Chaperone or investing in Chaperone
you're making an assumption that may not be the right assumption. You are saying that you want your employer, Oracle in this case, to invest in building a module for this existing product, which is a workflow product for FlexCube banking solutions, but you don't intend to charge for it. Is that what I'm hearing?
No, actually, last time we stopped at this point only, Shramana, that if it is a competition to existing product, and you suggested me to go to and check what that workflow software does. And I also went and checked with the people as to what it does, but I am actually not competing with a workflow software. Even though I have used the term workflow, well, I am not using even 2% of that original software. Okay. We should call it
I'm asking a different question. I'm asking you the question that you are proposing to put together a module, a product, right? A module of the product that's going to extend the current banking product of Oracle, and you're going to be selling this as an additional module. Is that correct or not?
Yeah.
So the question that I'm asking you is this a product that you're going to charge for?
Yeah, this can be charged.
Because if you're not going to charge for it, then what is the reason why should Oracle invest in this kind of a product?
See, if the bank requires it, then it is an additional thing that they will get. It won't be a part of base product. So banks will, we normally sell, or our licensing is based on the modules that bank is using. So the additional modules are required, they have to pay additional. Okay. So
Yeah.
Chaperone will be additional module which the bankers will be paying.
And so what is
Secondly,
the
the advantage to a bank.
what is the pricing assumption now?
Pricing assumptions, Ramana, actually, I don't know how my company charges or how the license cost is decided. So I am at a loss here. I don't know how
Have
they
you
will
done the
charge it.
pricing module of the curriculum?
Yeah, I have checked that, but since pricing the software is something is out of my scope, I don't know how it works in our company.
Program so that you can learn these things. So you need to go do the pricing module again. Sounds like you need to internalize it now that you are at a point where that is your next step. And you need to go do the research on how Oracle charges for the adjacent products and how much can you charge on top of that, etc. Go do the research and come back with data so that you can decide. Go do the the methodology, and then go do the research to figure out how to do pricing. Your next step is to figure out the pricing. All the rest is kind of right now. To come up with the TAM analysis, you're going to have to do pricing model. Okay. I'll check if I get any resource who can guide me on this thing. I'll also go through the pricing model again. Do you have any questions? Anything else that you wanted to discuss today?
No. This was the only point. See, last time we discussed whether this Chaperone will be a competing thing to the Oracle's existing product. So I have understood that it is not a competition because Workflow does 100 more things which I am not even touching. Yeah. So you want a very small module that will just be specifically focusing on workflow related to the banking product, and that's what you want to build, and you don't want to go into the big, heavy, workflow product that Oracle has. It's not necessary. That's the argument that you're making. That's fine. So now figure out for this small product, what is the right pricing. That's your next step. Okay. Thanks a lot. All right. Yeah. Thank you. Is there anybody else who's presenting today, Maureen? I see Sanjay Prabhu sending messages here. Sanjay, did you want to pitch? I don't see your slides here. Okay, well, I'm going to let Maureen figure out and let me know what is the plan. In the meantime, let me explain to you how to use 1 million by 1 million. If you like what we do here, and many of you have been here many times, bring other entrepreneurs, serious entrepreneurs, to the program. That's the favor that we ask of you. In terms of resources, everything is at 1Mby1M.com. There is the Entrepreneur Journeys book series, which is all available on Amazon. There are 12 volumes, and the blog is free. You can find that on our website. The books are case study based, so you can learn a lot by just following these case studies. And these roundtables happen week after week after week. They're great learning material. You can come and listen and participate and learn a lot. The full acceleration program from 1 million by 1 million is the 1Mby1M premium program, where we offer extensive methodology guidance, a full curriculum, extensive business development, strategy consulting, and help with financing and media relations as well. So you can go to the website, to the self-assessment, and there's a set of questions. These are strategy questions. You should go ahead and ask these questions of yourself, thinking about yourself as an investor in your own venture, and see how much of this you can get to, how much of this you can answer credibly. If you get stuck, go to 1Mby1M Basic and learn the curriculum. That will help you close the methodology gaps that you have. In any case, go to the website, dig around, and see if this is the right program for you. What to expect from premium, what to expect from basic, FAQs, video FAQs, description of the curriculum. We are a case study-based program. We
basically help you stand on the shoulders of other people who have done this before. So, case studies are a very big part of that process. Our methodology is lean, capital efficient, bootstrap startups. Philosophy is bootstrap first, raise money later. So all that is, you'll find lots of material on the website to decide whether this program is for you or not. And the upcoming free roundtables, there's one more in August, at the end of August, and then 4 more in September. I'm going to be in India for a couple of weeks, leaving tomorrow, which is why we're going to have a shorter session today. The next rendezvous, in-person rendezvous in Menlo Park, is going to be on Wednesday, September 4th. And we do have an in-person session in India while I'm there, an in-person roundtable. So hope I'll see some of you there. I will take a few questions before we adjourn, but I do need to adjourn a little bit quickly today because I am leaving tomorrow and I'm very busy today. So does anybody have questions? While you're figuring that out, let me introduce you to Irina Patterson. If you have questions about the program, Irina would be happy to answer. Irina at 1Mby1M.com. And that's it. Maureen, Jeff Snyder, there are a lot of people in the room who are all the participants. Today we don't have time to do more pitches. So normally we have up to 5 pitches, but today we don't have the time to do 5 pitches. So Jeff Snyder, if your question is, are you going to see more pitches today? The answer is no. We'll do a little bit of Q&A and wrap up because I have something else. Subodh Pathak is asking about details of the in-person meetings. Maureen, could you share the 2 links of the RKM event and the Kolkata pitch session? So Subodh, there are 2 events in Calcutta. One is a speaking engagement, and that's a large event and it's free. So if any of you are interested, you're welcome to come to that. And the other one is a pitch event organized by Thai Kolkata. And Thai, I think, it's free for members and there's a small fee for non-members, something like that. All right, I don't see any questions, and I think I've answered whatever questions I saw. So last call. If you don't have questions, Sanjay Prabhu has disappeared. He's trying to ask questions, but he has now disappeared. So I'm going to assume that you're not asking any more questions. So we will adjourn for today, but we'll be back. September onwards again, September, October, November, we have absolutely full sessions, and we have one more session in August as well at the end of the month. Talk to you soon. Thank you for coming today. Bye.